Okay, welcome to our first class for course of capital. So it is course of capital stroke capital structure. So course of capital stroke capital structure. I hope you can see the board. And where you are using your phone, if you are using your phone to log into the class, kindly don't tilt your phone. Don't auto-rotate. So make sure you don't auto-rotate. You use your phone in a normal way, the way you use your phone. So don't auto-rotate your phone. Anyway, let us move on. I hope my screen is clear. So cost of capital is our topic. And under cost of capital, we shall discuss about weighted average cost of capital and the marginal cost of capital, break-even point analysis. Then we have something like special cases in EPS and EBIT. And then the last one we shall talk about issue to do with leverage, operating leverage, combined leverage, and financial leverage. Okay, let's start with the first one. Let us start with the definition of the cost of capital first before we even move to something else. Now, when we talk about cost of capital, in most cases, we can have definition in two ways. We can have definition in terms of owner's perspective. So cost of capital can be defined into two ways. Number one, so can be defined in two ways. So can be defined in two ways. Number one, we have the business perspective. So we have the business perspective. So let us see it under business perspective. So let us see it under business perspective. So we can define it in two ways. So when you talk about business perspective, remember the business incur cost of acquiring finance. So that cost that the business incur to acquire finance, that cost is what we call the cost of capital. Example is the dividend. So if the firm acquires a fund through shares, they shall pay dividend in the future. So that form of payment dividend is a cost to them, and therefore we call it cost of capital. So that is under business perspective. Let us define it. Refers. So this is the definition of cost of capital under business perspective. So cost of capital definition under business perspective refers to cost incurred by the firm to obtain. So cost incurred by the firm to obtain capital or additional funds. So that is one. So when the business decides to go and source funds through, for example, loan, they shall pay interest. That interest is what we call the cost of capital. Or if the firm decides to source funds through issue of shares, then they shall end up paying dividend in the future. That one is called the cost of capital also, i.e. payment of dividend or payment of interest or payment of interest. So that is one way we can define. That is one way we can define cost of capital. So under business perspective, refers to the cost. You can also call it overall cost. You can also call it overall cost incurred by the firm to obtain capital or additional fund. So example of that cost is what we call dividend and interest. And then you can define it under owner's perspective. So another definition is under owner's perspective. So under owner's perspective, we are talking about the people who provided the fund to the business or to the company. Examples of the owners of capital are the shareholder or the bank. So for example, the owners of shares, of money through shares or funds through shares, we can call them the shareholders. So wamepeana pesa kwa niaba yao ndio kampuni iweze kuendelea. Ama tunaweza sema pia a bank can be an owner's perspective, kumaanisha au wamepeana pesa kwa kampuni itumike. So we can define it also in form of owner's perspective. This is how we can define it. And you can see refers to the required rate of return, refers to the required rate of return, refers to the required rate of return, attributable to investors, attributable to investors or providers of capital, providers of capital. So it refers to the required rate of return. So it refers to the required rate of return attributable to the providers of capital. Or you can also say refers to the return given to providers of capital. Refers the return given to the providers of capital. I.e., a good example ni dividend. So dividend ni kampuni inalipa the providers. So for example, shareholders ama investors walipeana pesa. So in future, all investors kwao wana expect that the firm itarudishia hiyo pesa plus marupurupu. So hiyo marupurupu kwao ni return. And therefore, apart defining it from the business perspective, we can define it under owner's perspective as a return to them, i.e. return, i.e. dividend paid to investors. So dividend paid to investors or interest paid to the financial institution. To the financial institution. So that is two ways we can define cost of capital. And that is very, very important. Two ways in which we can define the cost of capital. So number one, under business, remember, refer to the cost incurred by the firm to obtain the fund. And that cost is the payment of dividends. Or we can talk about the owner's perspective, and we can say that under owner's perspective refers to the return attributable to the providers of capital, i.e. dividend paid to the investors after contributing their money to the firm, or interest paid to the financial institution. So the interest paid to the financial institution after transferring the fund to the company. That is all. That is the two definition. So screenshot kama hujaandika, because I'm about to wrap it. So that is the two perspective. So that is the definition of cost of capital. That is the definition of cost of capital. So so in 1 minute, make sure you screenshot or you rub. So that is what we can say about the cost of capital. I think that one is a bit broad. Now we can talk about some of the significance of cost of capital. So we can talk about some of the significance of cost of capital. I want us to write something on the significance of cost of capital. So let us I'm rubbing. So kama hauko umeandika kindly say before nivute. So I'm doing away. So those are the two definitions tumeandika. Aha. Okay, let us talk about significance of cost of capital. Let us talk about significance. The European Investment Bank, which is the EU bank in partnership with the cooperative bank, is supporting estimated. Okay, significant number one. So number one, it assists in investment decisions. So how does it assist in investment decision? So how does it assist in investment decision? We can say cost of capital is used as a discounting rate, discounting rate when evaluating projects NPV. So that is all we can say. So when we shall be using NPV, for example, to carry out projects evaluation, then we shall be using the cost of capital. So the cost of capital shall be used as a discounting rate. So the cost of capital shall be used as a discounting rate when evaluating a given project. So i.e., for example, when we say about NPV is equals to cash flow, we multiply with 1 plus R raised to N. So the R will be the discounting rate, or cost of capital. So that one is number one. So the R, so it will be discounting rate of the cost of capital. So R, this R is the cost of capital or discounting. And then number two, so that one is number one. So the cost of capital is used as a discounting rate when evaluating projects or when doing appraisal of a project. So when we shall be doing appraisal of a project, then that cost of capital shall act as a discounting rate. Number two, assist in valuation of security. Assist in valuation of securities. So that says in valuation of securities. So what do we say? We can say cost of capital also also act as discounting rate, also act as a discounting rate when determining value of a share, when determining value of a share or interest, i.e., for example, PO, which is the share, value of the share, can be equal to, we can say, DO 1 plus G, KE minus G. Our KE represent our R, can also represent our R in some occasion. Or if you want to determine the value of interest, interest is given by, you multiply with 1 plus R is negative N. That one is just a normal two formula. So an example, it is not like the final one, but it is there to help us. So the R and the R here, KE, also represent the cost of, they also assist in valuation of security or the cost of capital. Okay, what else? Number next, assist in evaluating performance. Assist in evaluation.
Can I ask a question?
Yes, yes.
When we are talking about cost of capital as a discounting rate, what do we mean in regard to this discounting rate?
Discounting rate, it is that rate that is used to discount project from future cash flow to present cash flow. For example, let us to make a normal just example. Uko mahali unafanya, for example, you are evaluating a particular project. Your project wanakuambia that the cash flows in future, for example, we have like in the next 5 years. So we have today, present, then we have year 1, 2, 3, 4. So in year 1, automatically, for example, we know 40,000 is the cost of this project. 40,000. Let me put it here a bit. So we have a particular project. So we have today. So today as year 0, then we have next year, the year after next year, and so on. So today, if we want to invest in any project, today, that is year 0, we shall not have cash inflows. We shall have cash outflow. Kumaanisha hiyo pesa itakuwa inatoka. So ni 40,000. So this one is supposed to us. But upon investing this amount, then in future, we expect that what we invested tutapata pesa. So to assume in the next coming years, tutapata some cash inflow, pesa sasa inaingia. So this cash flow ndio tutatumia, the cash inflows ndio tutatumia to convert those cash flows to present value. Once we convert that cash flow to present value, we compare with our actual cost. So if we convert these cash flows in future in today's value, then we find that the value is more than our cost, then that project is viable. Kumaanisha hiyo project ni mzuri. So how do we convert it? We use the discounting rate. So hiyo tutafanya baadaye tukifanya investment decision, because that is a topic in itself. So wakati unafanya investment decision, mtakuwa mnaona how we shall be using the discounting rate to convert these cash flows to present. Tukishazipata in present value, then we compare with our cost at year 0. So if we compare and tupate cost is more than the benefit, then we shall automatically say that the project is not viable. That is the investment decision. I hope umenipata kidogo. So it is used to convert these cash flows to present. So for example, kama cash flow in year 4 ni 5,000, we convert this cash flow to year 0. So ni kama tunairudisha nyuma. Hii yenye iko year 3, also we convert it to year 0. Also yenye iko year 2, we convert it to year 0. Na pia yenye ilikuwa at year 1 mwisho, we convert it to year 0. So we convert all the future cash inflows, what we receive in future, to today's value. Once we convert it to today's value, then we shall compare it with the actual cost that we have incurred today. And then we give our decision. So that's what tunasema it assists in investment decision. We shall do it later, but I think that one is a bit okay. So that discounting rate is the same as hapa, pia ndio inatumika hapa na pia ndio inatumika wapi? Inatumika hapo. Okay, let us continue. We shall do more questions. Tukifanya swali kichini, tukae chini tufanye, I think we shall understand more. But for now, let us know that the discounting rate is a rate which is used to convert future cash flow to present value. So what we need to remember, so the discounting rate, you can say rate used to discount future cash inflows to present value. Nimetoka kwa bodi kidogo, but ni sawa. So remember, discounting rate, wacha niandike somewhere page inaonekana. Let me write this information somewhere here, ndio muione mzuri. So discounting rate, tunapea tu definition. For normal definition, just the normal, refers to a rate which is used to convert future cash flows to present value. And remember, when we say the present value, it is a value at year 0. So remember, when we talk about present value, it is the value of that project at year 0. So at year 0. So we're talking about today. So today, that is the present value. Anyway, I think that one is enough a bit, but we shall expound more when we shall be doing the investment decision as a topic itself. Number 3, we have said it is assists in evaluating performance. It assists in evaluation of performance. So it assists in evaluation of performance. So how does it assist in evaluation of performance? We can say cost of capital is compared to the required rate of return. So cost of capital is compared to the required rate of return to measure actual performance. To measure actual performance. To measure actual performance. So that the cost of capital, is compared with the actual rate of return to measure performance, i.e. So i.e. naandikia hapa, i.e. when cost of capital. So when cost of capital is greater than return, the project is not viable. That one is correct. So when the cost of capital is greater than the return, so the return, we are saying the rate of return. So when the cost of capital is greater than the required rate of return, the project is not viable. But when the return, the required rate of return is greater than the cost of capital, then the project is viable. When you talk about the word viable, we mean that that project is good. So when we're talking about viability, we are talking about that the project is good. The project is recommendable. Okay. So you need to remember that one. So I'm going to wrap also. So I'm going to wrap the first one. So tumesema, this is what we have said, when cost of capital, so naandika COC at cost of capital is greater than rate of return, then you can conclude and say the project is viable. And then also when cost of capital is less than rate of return, you can say that the project is this one is project is not supposed to be not. Then you can conclude here and say project is viable. The project is viable. So that is all. So that is all when we talk about cost of capital as significance when it comes to evaluation of performance. Number 4, let us go to number 4. Assist in financial decisions. Number 4, we can also add another one. Cost of capital assist in financial decision. So how does it assist in financial decision? Now, when unaenda kuchukua pesa, lazima consider the interest rate or the payment of dividend. So if ukaenda kuchukua pesa upate that you are going to pay more in the future as the cost, then you shall opt for another form of finance. We shall opt for other forms of finance. And therefore, this cost of capital help an investor or a company to decide how to source fund in a most cheapest way. So in a most cheapest way. So a person will choose that form of finance that is cheap. So that's why we're saying the cost of capital assists in financial decision. So what are the financial decision? What is the definition of the word financial decision? Remember, financial decision, these are the decisions available to the finance manager on how to source finance from various sources. So remember, anaweza enda chukue kwa bank, anaweza amua ku raise through preference shares, anaweza amua ku raise through ordinary shares, anaweza amua ku plow back the profit from the retained earnings. And therefore, an investor or a business will choose that form of finance that is cheaper compared to the others. Okay, so let us write something on that. So let us write something on that. We can conclude and say, because it assists the finance manager to source the best alternative of funds, which is cheaper, then you can say this. So it acts as a yardstick. So it acts as a yardstick. It acts as a yardstick during evaluation of sources of capital. During evaluation of sources of capital. Na tumesema a finance manager need to choose that form of finance that is cheaper, and therefore the cost of capital will assist him or her to see which form of finance is associated with minimum cost. So for example, if acquiring finance through shares is cheaper, then the finance manager will decide to make a decision to finance the operation using shares. If going through loans or debentures is cheaper, in that case, the finance manager will prefer to go with loans and debentures, and therefore it acts as a yardstick. So it acts as a control during evaluation of various sources of finance. So it acts as a yardstick or a control during evaluation of various sources of finance. Okay, that one is fine. So those are some of the significance of cost of capital. So those are the sum of the significance of cost of capital. So those are some of the significance. Now, with that, let us go to components. Tunataka tuharakishe kidogo. Component of cost of capital. So component. So component of cost of capital. Component of cost of capital. So let us define what is component cost of capital first before we do anything else. So component sometimes pay a little specific cost of capital. So sometimes called specific cost of capital. So sometimes it is also called specific cost of capital. And this is the definition. Refers, so this is the definition. It refers to the individual it refers to the individual. Sorry, it refers to the cost of individual component. Cost of individual. It refers to the cost of individual component. Ama tusitumie the word component kwa sababu tuko na jina component hapa. So it refers to the cost of individual, cost of capital. Individual cost of capital. So an individual cost of capital ni kama, for example, useme under equity finance we have things like cost of equity and cost of retained earnings. So the cost of equity and the cost of retained earning, that's an individual cost. Tukienda kwa debentures, we have cost of debenture, where it has maybe where it can be redeemable. Na pia we have another cost of capital of debenture where it is redeemable. Tukienda, for example, kwa loan, we have cost of loan where the loan has flotation cost, and we also have another form of a loan, cost of loan, where it doesn't have flotation cost, where it has and where it doesn't have flotation cost. Okay, so let's start with the first one. So these are the components. Number one, equity component. Now we can say number one, under equity component, we have cost of ordinary shares. Cost of ordinary shares, we call it KS. So cost of ordinary shares, we call it KS. So KS represent the cost of ordinary share, and this is the formula. KS is given by DO. Hapo mnaona DO 1 plus G PO minus flotation cost, if we have flotation cost, plus G, then you multiply by 100. And we say DO is previous paid dividend, and then G, growth rate, PO, market price of the share, of the ordinary share, in short. FC is the flotation cost. FC is the flotation cost. So this is the formula, NB. So make sure you remember, this is the formula used. In case of previous paid dividends. So this is the formula used in case of the previous paid dividend. So where the dividend has already been paid. So ukisoma swali, for example, wakati unafanya swali ya cost of capital, nitakuwa nawaambia kitu ya kwanza ukisoma unaangalia if the dividend were paid or not. If the dividend were paid, this is the formula to use. If the dividend were paid, that is the formula to use. If the dividend is not paid, then this is the formula to use. So if dividend is not paid, or it is expected dividend. It is expected dividend. Then KS will be equal to what? KS will be equal to D1 over PO minus FC plus G, then everything multiplied by 100. And then you say D1 represent expected dividend. Expected dividend. So D1 represent expected dividend. Okay. So that one is number one. Under equity component, number one, part A, we have the cost of ordinary share. Let's go to part B, still under equity component. Still under equity component, it is retained earnings. So part B. So part B. So in my case, navuta hapa tu. Hapa, make sure you check kwenye navuta. So part B, we have cost of retained earnings. So given by KR. So given by KR, cost of retained earnings. Cost of retained earnings given by KR. So what could we say about that one? Now under this one, because we are profiting it back from the business, we cannot incur the flotation cost. Remember, flotation cost, the cost incurred while obtaining funds from the public. Kumaanisha lazima mwende kwa public muadvertise, kuna charges, brokers, vitu kama hizo zote. Tukizicombine hizo zote, kuna bank duty, kuna check duties and so on. So tukizicombine hizo cost, we call them flotation cost. But because retained earning tuna prof back to the business, kumaanisha tu ni kutransfer, then it shall not have flotation cost. So that is the only tofauti. So hiyo ndio tofauti, haina flotation cost. So KR in this case now, KR will be equal to DO 1 plus G over PO only. So itakuwa tuna PO peke yake plus G, then everything multiplied by 100. So everything multiplied by 100. So we shall not have flotation cost. Cannot have flotation cost in that case. So where DO is the previous paid dividend, G growth rate, PO the market price of the share. So of the share, because retained earnings is part of equity. Then this is the formula used in the case of the dividend being paid. In the case the dividend is not paid, it is expected, then this will be the formula of KR. We say KR is equal to D1 over, we shall not have flotation cost because retained earning is amount that we have. Ni kutransfer to kwa business. So it will only have PO plus G into bracket 1 times 100. D1 becomes expected dividend. So that is all about equity component. So that is all about equity component. So what do you think you need to remember? You need to remember when we talk about the cost of equity, we don't have flotation cost. But when we are talking about KR, we have flotation cost. We don't have flotation cost. When we talk about the equity, the ordinary share, KS. So when we're talking about cost of ordinary share, that is KS, we have flotation cost for both paid and expected. But when we are talking about cost of retained earnings, KR doesn't have flotation cost for both paid or expected formulas. That one is fine. I think that one is okay. So that is the first component, equity component. So we are done with equity component. We go to number 2. After equity component, we go to debt component. Debt component. So number 2, debt component. And number A, we have loan. We start with loan. And loan is donated by KL. Cost of loan. KL as cost of loan. As cost of loan. Okay. So when I talk about cost of loan, we have 2 types of cost of loan. So wakati tunaongea cost of loan, we have 2 types of cost of loan. We have the one with flotation cost and the one with no flotation cost. So tuko na mbili. So the one with flotation cost and the one with no flotation cost. So tuanze na gani? Tuanze na without flotation cost. Tuanze na without flotation cost. So part A, KL, cost of loan without flotation cost. So KL without flotation cost, this will be the formula. KL is equals to I into bracket 1 minus T. Then we say I is the interest rate in percentage. T, tax rate. T, tax rate. So that is all about when we don't have flotation cost. So tuite part A ndiko rahisi. So number 2, the second component is debt component. Then part A, Roman 1, we have the KL, cost of loan without flotation cost. So hapa nimeandika vibaya, then niandike vizuri. Cost of loan, the bracket, KL. Okay. Then number 2, Roman 2, KL with flotation cost. With flotation cost. Now what can we say? That KL is equals to I 1 minus T into bracket. Sorry, not into bracket, over value of loan.
Can I interrupt you for a minute?
Yes.
I had an issue with the Wi-Fi connection. Can you start from the debt component? That way I was lost.
From
the debt component.
Oh, from the debt component.
Yeah.
Okay, let me start from the debt component. Okay, okay, let me do this. Let me do this. Wacha niziname tujue ni vitu gani hizo tunaongelea. So component. So we have equity cost of equity. Na tukasema hapa tuko na mbili, tuko na KR na tuko na KS. KR, cost of retained earnings. Tuko na cost of ordinary share. The second component tukasema ni cost of debt. Na number one tumesema tuko na cost KL, na anda hapo tena inakuja mara mbili, tuko na with flotation cost na without flotation cost. So that one is number one. Another component of debt tuko nayo ni debenture. So debenture, cost of debenture na iko mara mbili pia. So KD, that is the cost of debenture, iko mara mbili. Number one, where the debenture is, where KD is irredeemable, na pia KD number two, where KD is redeemable. So hiyo ndio tuko nayo kwa debenture. So where it is redeemable and where it is not redeemable. And also on debt number three, hapa ama nikiandika hapa chini tutatoshea number three hapa. We have preference shares, cost of preference shares, KP, na tukasema sasa hapa iko mara mbili. So iko mara mbili ya preference shares, iko mara mbili. Ya kwanza redeemable and irredeemable kama tu hapa. So we have one KP where it is irredeemable, na pia tuko nayo number two KP where it is redeemable. So ni hizo ndio unafaa kujua. Ni ngapi? 1 2 3 4 5 6 7 8, ni 8. So 8 of them. So under equity tuko na mbili, KR na KS. Under debt tuko nazo mara tatu. Tuko na loan, tuko na debenture na preference shares. Nitawaambia the reason why nimeweka preference shares in form of debt and not equity. Nitawaambia later. But for now, let us put it under debt. We put it under debt. Okay. Let us see. So let me start from nilikuwa nimefika penye alini-interrupt. Nilikuwa nimefika kwa debt. So I think hizo zingine ziko explanatory. So kwa debt tumesema tuko na loan. So kwa loan we have two types of loan. The cost of loan with flotation cost and the other one with no flotation cost. Let us start with the first one. So number 2, debt. And number 1, cost of loan. Cost of loan, KL. Cost of loan, KL. And we say, so iko mara mbili without rotation, without rotation cost. So without rotation cost, na tunasema KL is equals to 1 minus T, sorry, I 1 minus T, I 1 minus T, and we know our I is interest rate. Interest rate in percentage. Interest rate in percentage. So I is the interest rate in percentage. T, tax rate. Tax rate also in percentage. Also in percentage. So I is the interest rate in percentage, and T is the tax rate in percentage. KL, cost of loan. Number B, with flotation cost. Then you can say KL is equals to I 1 minus T VL minus rotation cost, and then everything we multiply with 100. So everything we multiply by 100. Now we can say I interest rate. Interest rate. So interest, not rate, interest in value. So it is interest in value and not in a rate. So interest in value and not in form of a rate. So that one is for number 1. Interest is in value, absolute value. And then T, this one is common, tax rate in percentage, tax rate in percentage, VL, value of loan. VL, value of loan. Then we have FC as flotation cost. So FC as flotation cost. So that is all about loan. That is all about loan. So remember, for a loan, we have the one with flotation and the one with no flotation. So you need to remember those 2 items, with and without flotation cost. So that is number A, part 1 under debt. So loan. So number 2, let us go to number 2 to preference shares. Number 2, we go to preference shares. So number 2, preference shares. This one is KP. So preference shares, which is KP. Now let us summarize this one. KP can be redeemable or irredeemable. We start with the one which is irredeemable. So we start with the first one, which is irredeemable. And you can say KP is equals to dividend. So I need a div over PO minus rotation cost. Then everything you multiply by 100. So everything you multiply by 100, where div the dividend of preference share. So dividend of the preference shares, PO market value of preference share, FC rotation cost. FC is the flotation cost. So that is all. Oh, that is all about irredeemable. That is all about irredeemable. So dividend over PO minus FC, then everything you multiply by 100. Remember, dividend is the dividend of the preference shares. Remember, PO is the market value of preference shares. Okay, let's go to redeemable. So redeemable. So when it is redeemable, so KP will be equal to div plus PVP. So tasema inamaanisha nini baadaye? PVP plus MVP over N. Then everything you divide by PVP minus MVP over 2. Then the answer you utapata, you multiply with 100, where PVP is the par value of preference shares. So PVP par value of preference share. PVP is the par value of the preference shares. Remember, when we talk about par value, it is a value of a share that existed before the market price. So when wakati tunaongea kuhusu par value, we are talking about the value of that share that existed before market price. So sometimes the word par value is called nominal value. So sometimes the word par value is known as nominal value. So nominal value is the same as par value, which refers to the value of a share before the market price. So for example, kama jana, the share was trading at 20 shillings. Na today ni 21. So ilitoka 20, ikakuja 21. So the 20 is the value before the market price ya leo ya 21. So that value is called the par value. So if yesterday the value was 20 and today the value is also 20, then the par value is same as the market value. So you need to remember that one. So MVP, market value of the share. Market value of preference shares. So market value of preference shares. So market value of preference shares. And we also have N, maturity period. Maturity period. So the period the firm will take before redeeming their money back. So the period the firm will take before redeeming their money back. And then div is the dividend of the preference shares. So that is all about the preference shares as the second component of debt. So that is all about preference shares as the second component of preference shares. Let's go to the third one, which is the last. Then we do a question from past paper. We shall do at least 3 questions today. I think it will be possible from our past paper, starting from the last sitting kama iko. So let's go to the third one. We call it debenture. So debenture as the third part. So debenture also can be redeemable or irredeemable. So start with the redeemable. So under redeemable, so remember debenture is KD. So remember we talk about debenture, it is KD, cost of debenture. So for KD, when it is irredeemable, KD I 1 minus T, then everything we divide the market value of the debenture minus rotation cost minus discount kama iko, then you multiply by 100, where I interest in value. So in value and not percentage, mko very keen. I interest in value and not percentage. And then you have T as tax rate in percentage. So T as tax rate in percentage. Then you have MVD, which is market value of debenture. Then you have FC as flotation cost, as flotation cost. And then gani ngiri kona D, which represent discount. D represent discount. So that one is all about redeemable, irredeemable. Then we can go to redeemable. So redeemable, KD is given as follows. I 1 minus T plus so tunasema I 1 minus T plus PVD minus MVD divided by N then everything we divide by PVD plus MVD over 2. Then we multiply by 100. So ile ya juu, hebu angalia ile ya juu yuko tumeweka ile ya redeemable and preference shares. Aina hapo kwa per value of PVP, per value of the preference share. Angalia kama ni minus, uweke minus. Na kama niliweka plus, inafaa iwe minus. Kwa hiyo ya preference shares, hebu uangalie ilikuwa PVP, inafaa kuwa PVP minus MVP pale juu kwa preference shares, and then uweke minus. Anyway, we say PVP, not PVD, per value of the debenture, then MVD market value of the debenture, and maturity period, then I the interest in value, not percentage, and then you have T as tax rate in percentage, tax rate in percentage, tax rate in percentage. So that is all about the components. So that is all about the components. So so I want to define two components here. Other items, we have weighted average cost of capital and you have the marginal cost of capital. So I want to do one of them today. Then tomorrow we shall do another one. So today we shall do only work. Then tomorrow we shall do the marginal cost of capital. Okay, let us introduce the weighted average cost of capital. Weighted average cost of capital as our last component. Then we do a question from past paper. At least we do a question. It is good we do a question. Okay. Okay, we can now proceed. So weighted average cost of capital. So weighted average cost of capital, and we say that this refers to the overall cost of existing capital. So unafaa ukumbuke the word existing. So your definition without the word existing, then that one will not be weighted average cost of capital. It must have the word existing. That is the main thing. So it refers to the overall cost of existing capital of a firm. So it refers to the overall cost of capital. Refers to the overall cost of capital. Sorry, refers to the overall cost of existing capital of a firm. So it must have the word existing. So your definition without the word existing, then that one is not, that is not work. So that is not work. So we call it work. Weighted average cost of capital. So remember your definition without the word existing, then that one is not work. So refers to the overall cost of the existing capital structure. Na tukiongea existing capital structure, we are talking about those items zenye ziko kwa balance sheet. Ukienda kwa finance by. So ukienda kwa finance by, if your current capital structure, sorry, if your capital iko na assets, not sorry, not what am I saying? Nasema tukienda pale kwa balance sheet, kuna place na kuna imeandikwa finance by, wachana na assets, hizo current assets na non-current, achana nazo pale chini hizo zingine. So you have finance by, you have equity, preference shares, debentures, and so on. So zenye ziko kwa your current balance sheet, those are the existing. If you want to add others to the current, then that will not be weighted average, it will be marginal. So we are talking about what you already have, the balance sheet, and the part of capital. That is all about the weighted average cost of capital. So ukumbuke, existing is what we have, and that one is the work. And then you can continue and say, work is normally computed using market values. So work is normally computed using market values, market value. And then you continue and say, KR, which is the cost of retained earning, KR, which is the cost of retained earning, is not included in the computation of work. So KR is not included in the computation of work. So the cost of retained earning, KR, is not included in the computation of work. So that is very important. Make sure you remember that one, that the retained earning is not included. It's not included in what circumstance? When you are using the market value in computing work. So if we are using the market value to compute the work, then KR is not included. But if we are going to use the book value, so ukiona unatumia book value, in most cases book value hakunanga, ni ngumu, sijaona swali kama hiyo. Though in case you are using book value, then you shall include work. You shall include KR in computation of work. But because in most cases we are going to use the market value, we shall be ignoring the component of KR. Okay. Steps in computing work. So let us jump to a past paper. So tuende kwa past paper.
Just to ask,
Yes.
do we have a formula where we can compute this WSCC?
WSCC, we have a formula. I can give you a formula, just a general formula, Sivyo. Yes.
Yes.
So when you talk about work, we need the weight. So because we are dealing with KS, so we need the KS. Then we multiply it with the weight of S. So cost of ordinary share, we multiply with the weight of share. We add cost of preference shares, we multiply with the weight of preference shares, and maybe gani ingine tunaweza weka ya KD, cost of debenture, we multiply with the weight of debenture. So this is the general formula. So that formula is not inclusive of KR. So that formula is not inclusive of KR. So if you end up including KR, then we shall be concluding you are calculating the marginal cost of capital. So if you include KR, we shall conclude you are calculating the marginal. But this one is not inclusive of KR. So NB, the formula is used when market value is used. So the formula is used. So the formula is used when the market value is used. Okay, let me see if I shall get a question from past paper.
Then another question.
Yes.
I've seen we have added other things like the weight of S, weight of preference, and weight of debenture.
Oh, yeah.
How then are we going to get the figures for this weight?
Of the weights. So that's why we are saying we are using the market value. We shall get the weights using the market value. Wacha tufanye a question ndio ikuwe rahisi, sivyo? So W means the weight. So let us do a question ndio ikuwe rahisi kwetu, sivyo? Let us try with a question ndio ikuwe rahisi kwetu. So I hope you have a past paper with you, but I'm going to present one here. So I hope you have a past paper with you also. You can open a past paper from your end. Kwa sababu nita present and then nitoe. So I hope you can see the last sitting. If we start from the last sitting, we have a question from last sitting. Let us see. Question 1, no. Question 2, no. Question 3, no. Question 4, no. Question 5. Question 5 also no. So last sitting there was no question for work. So last sitting they did not test, meaning we can find it this season, this coming this sitting, because the last sitting there it was not there. Let us go to December. So December, yes, we have it. So December, this is December, which city? December, this one is December 2023. So we have a question from December 2023. So I'm going to present it. Let me write it here, that question. So the question is from December 2023. Question number December 2023. Question number 4B. Question number 4B. So can you see the question? Anyway, let me assume you can see the question. Now, the following is an extract of the statement of the financial position. Now, hii ndio nilikuwa nawaambia. This is the existing ones. Unaziona hapo. Financed by. So you have the equity in form of share capital, retained earnings, then you have the total equity, then you have non-current liabilities, long-term borrowings, current liabilities, na total liabilities. So that is all. So ukipata swali ya work, the first thing unaangalia ni hizi. And in most cases hapa tutatumia share capital and retained earnings because that's the two components that we have. Then kwa non-current, the only item tutatumia hapa ni borrowing, because the rest they are not, we shall not categorize them as component cost of capital. For example, current liabilities hatujui iko na nini na nini, but long-term borrowings tunajua inaweza kuwa either debt or inaweza kuwa debt in form of loan or debenture. So in most cases tutakuwa na 3 items: share capital, retained earnings, and long-term debt. So kindly make sure you screenshot the question because I'm going to do it now. Now, ama kuliko screenshot, nataka uniambie, kindly tell me if unaweza enda kwa board na pia urudi kwa screen. Is it possible to navigate ufinye board na pia unafinya huku kwingine kwa swali? Hebu jaribu afu mniambie. Okay, kuna mwenye ako na hard copy, Eric, na huyu mwingine ni nani? Huyo mwingine ni Martin. Martin ama Aman.
Yes, I have it. I have the question.
Okay, so tunaweza endelea. Okay, let us read the question. So I'm reading the additional information. The ordinary share of oak timber consists of 12 million. Kidogo, just a bit. So tunasema the ordinary share of work timber consists of 12 million ordinary shares and 5 million 5% irredeemable preference shares. So those are the number of shares. Oh no, that one is value. So the 17 million pale juu kikuja hapa kwa 17, this 17 hapa kwa 17. This 17 is made up of two items. Wanasema it is made up of share capital, which ni ordinary share 12, and then 5 ni preference shares. So carry the two. 12 plus 5 is 17. So this 17 is made up of two items, KS na KP. That one is correct. That one is fine, I think. Baka hapo. Okay, let's continue. The ordinary shares of work timber have a nominal value of 0.5 per share and ex-dividend market price of 7.07 per share and a CAM dividend price of 7.52 per share. So I'm going to explain what is CAM dividend and what is ex-dividend. Tukifanya swali. Anyway, let us continue. The dividend for the year 2023 will be paid in the near future. So the dividend will be paid in the near future, meaning the dividend has not been paid. So that one is expected dividend. So the dividend has not been paid. Sawa. Number 3, the 5% irredeemable preference shares of work timber have a nominal value of 0.5 per share and an ex-dividend market price of 0.31 per share. Number 4, long-term borrowing consists of 10 million, 7% loan, and 3 million bank loan. So ile pale juu, hii 13 million hapa kwa balance sheet hapa juu. It is made up of two items, loan ya 10 million na a loan of 10 million and a loan of 3 million and okay, loan note and a bank loan. So 10 million and 3 million. Number 5, the 7% loan note has a nominal value of 100 and a market price of 102.34. Annual interest has just been paid. That one is fine. At a 5% premium to the nominal value, then the tax is 30%. Required cost of equity, cost of preference shares, cost of 7% loan, and work. So let us start. I'm going to do it with the steps. So step number 1. So steps. So define the steps, but in an exam, sio lazima utumie step. So hapa hivi ni purposely for class, natumia step. So step number 1. So step number 1 that we shall use is, let me see the step iko wapi, imepotea. So step number 1, so ndio hiyo sawa, nimepata steps. Number 1, step 1. Step 1, compute specific cost of capital. Compute specific cost of capital. So what is our first one? We start with KS. So we start with KS. What is the formula for KS? So KS, so because this one is expected, then it will be D1 over PO minus FC plus G times 100. So what is our D1? What is the dividends?
Why are we saying it is expected and I can't see such a note some?
Such a note somewhere. Let me go to the question. Hiyo swali yangu acha nirudi kwa nini. If we read this question, where is it? Information number 2. Let us read information number 2. The ordinary share of work timber have a nominal value of 0.5 per share, an ex-dividend market price of 7.07 per share, and a come dividend price of 7.52. The dividend for the year 2023 will be paid in the near future. So the dividend will be paid in the near future. Kumaanisha the dividend is not paid. Kama wanasema it will be paid in the near future, ni kumaanisha hiyo dividend haijalipwa. Si umeiona hapo?
Yes.
Umeiona?
Yes.
So kumaanisha haijalipwa. So that's how to this formula. This formula is for expected. So they expect to pay the dividend in the near future. So let me look for the question again. Nimeipoteza. Ngoja, where is it? So that is the formula. Now what's our D1? So mwenye akona swali hapa tuambie nikitafutanga. Kwa simu nataka nitumie simu kwa sababu hii nyingine nimepresent na kurudi huko inanichukua muda. Let me look for that question. Where is it? Sawa. So the dividend, it is expected to be paid in the near future. So what is the dividend that was paid today? So this one is 2022. So ukienda kwa 2022, we have a dividend pale unaiona ya 0.43. Can you see it? So our D1 is 0.43. Sijui kama unaiona per share. Sijui kama mnaiona 0.43 kwa information number 2. If you go to information number 2, we have a dividend of 0.43, meaning the dividend for 2023 has not been paid, but we expect that the dividend will be paid in the near future, and therefore we go with the previous dividend. Okay. Not previous, I mean this one. We need to find, sorry, niko zangu. We need to find expected dividend. So how do you find expected dividend? I want to talk about come dividend before we even find this dividend. Let us talk about come dividend and ex dividend. Kwa sababu hizi vitu zimekuja. Come dividend and ex dividend. So let's talk about it before tufanye swali, because we need to define what is ex dividend and what is come dividend. Okay, let us start with come dividend. And we say under come dividend, the shareholder, that one is very important. Under come dividend, the shareholder is paid dividend. Is paid dividends. Is paid dividends. Is paid dividends, whether the firm declares dividend or not. Whether the firm declares dividends or not. That one is very, very important. Under come dividend. So if a shareholder hold a form of dividend which is come, whether the firm declares dividend or not, that person will be entitled to be paid the dividends. That is what we need to remember. Under come dividend, that any person or any shareholders who hold the shares in form of come dividend, whether the firm declares dividend or not, that person will be paid. And this is the formula for getting market price per share under come dividend is equals to come dividend minus dividend minus dividend minus dividend. So that one is correct. So make sure you remember that one. So under come dividend, the shareholder is paid dividend, whether the firm declares dividend or not. Let's talk about X dividend. So under X dividend, so the shareholder is not entitled for dividend payments unless the company declares dividend. So the shareholder is not entitled for the next payable dividends unless the company pays dividends. So sorry, unless the company declares dividend. That one is correct. So under X dividend, the shareholder is not entitled for the next payable dividend. So the shareholder is not entitled for the next payable dividend unless the company declares dividends. So unless the company declares dividends. That one is all about that one. So now the formula. So market price is equals to X dividend plus the dividend. So X dividend plus the dividend. So X dividend plus the dividend. Now, so let's go to this question of ours. I want us to go to this question of ours. Now we need to find the KS. So let's find the KS. So what will be our dividend now? D1. So what will be our dividend? Someone atuambie. So the next dividend could be the next payable dividend in the future. Now, our next payable dividend, so for us to get the next payable dividend, it will be equal to the CAM rate. What is our CAM rate? Dividend? Our CAM dividend is 7.52. Ukiona pale kwa swali. That one is dividend, this one. Remember it is this one, CAM dividend. And then we have another one, X dividend, which is 7.07. 7.07. Therefore, our expected dividend to be paid in future. Our expected dividends expected to be paid in future is the difference between the two. 7.52 minus 7.07, which is Kenya shillings 0.45. The reason why nimechukua CAM dividend nikaraise X dividend because CAM dividend is inclusive of the dividend. The matter less. The person will be paid. So our CAM dividend has the dividend in it, whether the firm declares dividend or not. For X dividend does not have the dividend. That's what you add back. Haina kumaanisha CAM dividend iko nayo ndani. X dividend haina. So ukichukua yenye iko nayo yenye haina minus utapata the amount of dividend ni tunaongelea. So 0.45 is our, so hapa 0.45 for 2023. So that means for 2023, not 2022, is 0.45. Do you have our PO? Our PO in the question, remember our PO should be, how do we get our PO? This one, our market price. You take the CAM dividend you less the dividend. So kama tutatumia hiyo ya juu, most tutatumianga hii. Tutatumia hiyo. Kama utumii hiyo, then unaenda na huyu venye yako x dividend, kwa sababu x dividend haina the dividend ndani. So either utumie huyu 7.07 hapa, ama uchukue the PO through the CAM dividend minus x. So for example, our CAM dividend is 7.52 if tunatumia hii formula to less our dividend, expected dividend 0.45. So we shall get our PO. Kama sio hivyo, unaenda na x dividend, haina dividend ndani already. So if we less, we shall get 7.07 as our PO. 7.07. What else do we need? We also need our G, kwa sababu lazima to work na G in this case. So our growth rate. So we have to formula for growth rate. Naweza vuta hii account dividend na x. Watu wangu. Sawa sawa. So I hope naweza vuta hii CAM na x dividend. So nimesha explain. CAM dividend.
Hebu rudia hii ya PO.
Ya P, unaona PO, we can get PO using this formula. CAM dividend minus this dividend. Now, nimetumia this formula because the CAM dividend, because the person is entitled for the dividend, whether the firm declares dividend or not, the CAM dividend is already inclusive of the dividend ndani. It is already inclusive. That one is automatic. And therefore, to get the market price, unachukua CAM dividend, una minus the dividend. And our CAM dividend requires 7.52 to minus our expected dividend, because that one is what we expect in the future. Because, so tunatumia this formula because CAM dividend is already inclusive of the dividend ndani, kwa sababu that person is paid whether the firm declares or not. Yeye anajua tu atalipwa. In either way, firms makes profit or not, yeye analipwa. So kumaanisha when you are talking about CAM dividend, it is already inclusive of the dividend. So ndio tupate the market price, tunatoa the dividend. Ndio hiyo 7.52 minus the dividend. Or kama unatumia x dividend, then unatumia x dividend as MPS direct. But I prefer this one, CAM dividend. But kama pata kwa example pata x dividend peke yake, then we shall treat x dividend as MPS. Kama haujapatiwa CAM dividend. But where we have CAM dividend, use CAM dividend. You less the dividend direct. So that we get 7.52 minus 0.45. I think that one is a bit explanatory. So in an exam, yes, mostly avoid x dividend, the word x dividend. So use CAM dividend to get the PO. Otherwise, kama utaki kutumia CAM dividend na umepatiwa zote mbili, so x dividend will be your market price. Tuko sawa? So unaweza vuta?
Yes.
So that is the case of CAM dividend and x dividend. So G is the growth rate. So G can be found in two ways. Number one, so G is equals to B. Inakwanga B times R, or G is equals to N minus 1 DO over DN minus 1. I think that is the correct one. We shall check. Let me confirm the formula. Ndio tukue tunapeana kitu yenye tunajua ni nini. Now G iko sawa. So G, so tukianza na huyu, this B times R. B is the retention ratio. Ratio. R is the return on equity. According to this question, we cannot use this formula. So according to the question, we cannot use this formula. Reason why? Because we don't have the retention rate and we don't have return on equity. Now, our next formula to use is the one for G, where G is equals to n minus 1 dO over dn minus 1. Let us explain what is dO and blah, blah, blah. So dO, latest dividend, dn, earliest dividends, n, number of period, n as the number of periods. So that is the formula we shall use. So that is the formula that we shall use. So na stop kushare the screen so that nione hii swali vizuri. Now, let us do this question. Now, let us find G. G. So what is N according to the question? So it's from which year? Our dividend. Now, should we include the dividend for 2023? 0.45 ama tutumie yenye kopare kutoka 2019 mpaka 2022. So let us use najaribu kufikiria. Do we use from 2019 to 2022? We can use also that one. So the latest. So what is the period between 2019 to 2022? So period between 2019 to 2022. So how many years? 4. So 4 minus 1. So your formula is n 4 minus 1. DO is the latest. So what is the latest dividend from the question? The latest dividend in year 2022, which is 0.43. And then earliest dividend ni ngapi? Earliest dividend ya kitambo 2019 ya kitambo 0.37. So unachukua the latest and then ya kitambo, then you minus 1. Then you multiply by 100. So this formula iko na n minus 1 kweli? I think so this one haina n minus 1 hapa. Hapa usiweke n minus 1. So this one is supposed to be n. So minus iko hapa. The other side. So let it be n minus n, not n minus 1. So with this formula now we can find the G. So kama tungetumia hapa 0.45 hii, hapa tungeweka 5, sivyo? So kama tungetumia hii, tungeweka hapa 5. So but ni sawa tu. Either way. So unaweza amua uweke 0.45 hapa. So itakuwa mpaka 2023. Then hapa itakuwa ni 5. So 0.43 divided by 0.37. Then minus 1 times 100. So this is 0.8. So this is 3.8%, which is approximately 4%, which is approximately 4%. So 3.8%, which is approximately 4%. So that is the growth rate. That is the growth rate. So mimi nime round off to the nearest whole number. So that is how you get the G. Or kuna mwenye angefanya hivi, mimi naona pia huyo angekuwa correct pia. Aseme 5. Then achukue mpaka 2023 kwa sababu tuko na 2023 expected, though haijalipwa but we expect 0.45 over 0.37 minus 1. Then you multiply by 100. Also, this one will give you approximately same answer. 0.45 divided by 0.37. Then answer minus 1 times 100. 3.99. This one will give you 3.99, which is approximately 4%. Which is approximately 4%. So tunasema G is 3.99%, which is approximately 4%. Now tuko na every information. So we have all the information. Now we can get. So nataka nivute. Now we can get. Now we can get our KS hapa. So KS is equals to 0.45 over our market price. Our market price is 7.07 plus G 0.04. Then everything we multiply by 100. So we shall get that answer. So let us get it. So 0.45 divided by 7.07 plus 0.04 times 100, which is 10.36%. So 10.36%. So our KS is equals to 10.36%. Now, after KS, we also need to find. So after KS, so we ignore KR because in work, we ignore KR. We go to the next one. Tuenda kwa KP, nimeona somewhere KP, cost of preference shares, we have it. Information number 1. Information number 1, we have KP. KP, iko wapi imepotea? After information about KP. Information number 3. Information number 3 for KP. Let us talk about KP. KP is given as div over market price times 100. So what's our div? Our dividend. Now, our dividend under KP is given by percentage of par value. So can you remember that one? So for you to get a dividend, it is the percentage of the par value. So what is the percentage? The percentage information number 1. The preference shares is 5%. So 5%. So I'm going to put 5% of the par value. So what is our par value? Information number 3. The par value is 0.5. Our par value is 0.5 Kenya shillings. So what will be our dividend? So our dividend will be equal to 0.05 times 0.5, which is approximately Kenya shillings 0.025 per share. So that's how you get the dividend, percentage of the par value. Unaangalia pale juu percentage ni ngapi? So percentage ni 5% wametuambia. And then the par value is a nominal value. Remember, the par value is a nominal value. Now, if you get information number 3, the 5% redeemable shares have a nominal value of 0.5 per share. Remember, it is ex-dividend. Now, KP, so itakuwa ni 0.025 over the market price. Now, the market price is what? So the market price is ex-dividend. Joba ametupatia the word ex-dividend, then that one becomes the market price. Venye tu iko. It is not inclusive of the dividend. So that one will be equal to 0.31. So kama ingekuwa ni kama dividend, ndio ungefanya marekebisho kidogo. ungetoa. But for now, because ametumia ni ex dividend, so the ex dividend wamekupatia tu hivyo bila anything else. So that one becomes the market price. Then we multiply by 100. So what will be our KP? So divided by 0.31, then times 100, which is equals to 8.06%. So 8.06%. So hiyo tumemaliza ni KP. Information number 1 tumemaliza, information number 2 tumemaliza, information number 3 tumemaliza. Number 4, we have the one for K for loan. So we have two types of loan. The long term loan consists of 10% and 10 million 7% loan note and 3 million bank loan. Yeah. 7% loan note have a nominal value of 7% and the market value of 1 or 2.34 per loan. Annual interest rate has been paid and the loan is redeemable for 4 years at a rate of 5% premium for the nominal value. Now, hapa tuko na two type of loan. Tuko na 10%, tuko na 10 million, tuko na 10 million na 3 million. Now, for 10 million is redeemable. For 10 million, according to the question, information number 5, the 10 million is redeemable. But for the 3 million, the loan is variable. Kumaanisha, if it is variable for bank loan, for bank loan, here 3 million, it is variable. Meaning, our formula is, kama ni variable, ni I1 minus T. If it is variable, I1 minus T. So itakuwa ina change because of the tax rate. If the tax rate change, then the interest will be changing. So that bank loan. But remember kwa swali yetu hajatupatia the rate, the I. So hatujui I ni ngapi. But we can conclude and say, because zote ni loan, kuna uwezekano walichukua loan zote at interest rate of 7%. That is what we shall assume or we shall conclude. Because all of the two items zilikuwa ni loan, tunasema wakienda kuchukua kwa market zote zilikuwa at the same rate of 7% because it's variable. Now, this one will be equal to 7%, 1 minus the tax rate. So, okay, that one we get, sorry, I is 7%. So this one is for the one which is the variable. So KL will be equal to 7%. Tulisema EI, it is in percentage, ndio maana naweka hapa 7%. 1 minus tax rate, which itakuwa ni ngapi? So 7 times 0.7, which is around 4.9. 4.9%. Then we have another loan from the information number 5. Let us read the information number 5. So information number 5 wanatuambia that the 7% loan has a nominal value of 100. Remember, nominal value is the par value. So this will be the formula. I 1 minus T plus you take the par value of the loan minus market value of the loan divided by the maturity period over par value of the loan. Because it's on a maturity, we shall use this one, market value of the loan divided by 2. So tunatumia ile debenture in short. So ni ile kama ya debenture, basi tunaweka the word L hapa kwa sababu hatuna option. So tunatumia hiyo because hatuna option. That is the only possible way to use that formula to get the KL. So what will be the value of the KL from that information? So let us do it. Juu kama inaonekana. Sawa. So tuifanyie hapa juu. Let me do this one. Kwenda kuweka KP tuko na KL mara mbili 7%. Tuko na huu mwingine